Hello and welcome. I'm Anant Rangaswamy. The big news from Adland this week was the collapse of the proposed Publicis and Omnicom merger. The $35 billion merger plan, which would have created the world's largest communications holding company, was called off on Thursday evening. Announced nearly 10 months ago, both Publicis and Omnicom cite various challenges, including the slow progress of the completion of the transaction as reasons for calling off advertising's largest M&A deal. Animesh Das reports.
It was dubbed a merger of equals. Announced with a lot of fanfare last July and originally expected to close by the end of 2013, the $35 billion merger between Publicis Group and Omnicom Group would have created the world's largest communications company. But all that changed Thursday evening. A joint statement issued by both parties called off the merger. The statement says, and I quote, "The challenges that still remain to be overcome, in addition to the slow pace of progress, created a level of uncertainty detrimental to the interests of both groups and their employees, clients, and shareholders." The parties have released each other from any obligation with respect to the proposed transaction, including payment of any termination fee. A $500 million termination fee would have applied if either of the parties had decided to walk away unilaterally. The statement continues, and I quote, "We have thus jointly decided to proceed along our independent paths. We of course remain competitors, but maintain a great respect for one another."
One of the principles was that there will be equality in the management team. This has not been the case in the proposal of Omnicom, and I was going back and forth to try to convince them that we should have equality, and it was impossible to get that equality. And this was not the term of the agreement. The second aspect is that we have a model, which is the Publicis model, which everyone knows well in our industry, which is delivering the highest margin of the industry, and is supported by a production platform, shared services, a central IT, a new ERP, etc., etc. All this model is delivering superior margin. And we had the feeling that, in fact, that model may be diluted, and the promise that we made to the market that we will deliver superior margins will not be met.
The merger was expected to generate up to $500 million in savings, and in August 2013, the two CEOs had told CNBC that the move would have given them more heft in competing against Silicon Valley giants.
We have done a lot of deals, but this one has a lot of reason to exist. The most important one is that it's an excellent combination for our clients. We have to think first about the client, what this new world is creating as issues for our client, and we believe that this combination is something which will help them coping with all the changes which are happening in this world, and particularly with the internet giants. So this is something which has a lot of good reason.
The marketplace has moved, and it's changing. It changes every day now, whereas in truth, up till 10 years ago, it didn't change very rapidly. You had time to absorb the changes, intellectualize them, re-educate your people. Now changes are instantaneous, and this gives us the combined resources plus an array of assets that we can service every client need, and we'll be terribly nimble at the same time in being able to shift to changes in the marketplace.
This historic merger would have ousted WPP from the top of the global holding company ranks. The Publicis Omnicom Group would have also led the stakes in the effectiveness as well as the creativity race, if the measure is number of awards won. Though they maintained a brave face, recent comments from John Wren and Maurice Levy had set rumor mills ablaze with speculation regarding the deal's future. Both CEOs will now surely have to face questions over their strategy. In Mumbai, Animesh Das.
The collapse of the planned merger of equals means rival WPP Group gets to keep its top spot in the industry by revenue at $17.25 billion. But before we get talking to Sir Martin, we must play out an earlier interview that I conducted with him last September in New Delhi. This is what he had to say about Publicis, Omnicom, and how the merger would affect WPP. Coming to the POG that you referred to.
Yes.
Does it change anything? POG, does it change anything in India?
Well, it must change. It must change. Well, let's just think about it generally for a minute. It must change when number 2 and 3 get together. primarily probably because they're worried about number one.
Who is? Okay.
I think that.
Okay,
I think that's what drove it. I think it was. It must have been some of the things that we've been talking about. You know, client consolidation, the rise of finance and procurement. But I think, you know, frankly, the O ran out of space, and the P was worried about the future. So I think it was very. POG is very defensive. Actually, it's strategically a volte-face. It's structurally clunky. It will have regulation issues. And from a client and people point of view, they've been unable or unwilling to explain the benefits. I mean, they talk about, you know, leverage against Google and Facebook, which is ironic because they haven't gone head to head as we have. But I mean, we've carved out, I think, a very good relationship with Google and a very good relation with Facebook, but on the understanding that we are the independent arbiter for our clients.
Right.
That, you know, Google sells Google, Facebook sells Facebook. You wouldn't give your media plan to Rupert Murdoch. You wouldn't give it to a media owner to run. So why would you do it with Google or Facebook? So we act as the independent arbiter between, you know, the holy grail in our business is, if our media book is 90 billion and we thought it was one client, is that the right figure? Should it be more? Should it be less? And where should it be distributed? Going back to our conversation about where we, you know, how should we optimize it?
Right.
How should we optimize the media plan? Where should we invest it? That's really what we're about. So that's critical. And I think POG, you know, talk about, well, we'll be able to compete more with Google and Facebook. Well, come on, you know.
Do you think they'll, you know, launch something like a Group M?
I think they will try and move towards that. But coming back to the benefit to clients and people, on the people front, you know, to get to where we have got to with Group M will take a lot of time, a lot of effort, and when you make an omelette, you break eggs.
Right.
And there's going to be a lot of broken eggs.
Right.
But I think they've got a big regulatory issue to deal with, and that'll take time. It won't stop the deal, but it'll take time. And the second thing is they then have to consolidate it, right? And co-CEOs and co-chairmen and committees. You know, one of our competitors said, as we said last night, described it as a flying pig. I thought that was a little bit unfair. I think you get a flying camel.
Right. Okay, coming back to India. So POG in India, does it bother you at all?
Well, I think actually, you know what it does? I think it makes us sharper.
Right.
So I think what it does is actually it acts as a very good stimulant.
Right.
A stimulant to our people. It gets us to analyze our business even more intensely, to think about our business more intensely, to sort of overcompensate for the things they miss on. So, for example, what's the client benefit of what we do? What's the people benefit of what we do? And that's the heart of our business. I mean, that's really what it's all about. And therefore, I think it's good. It makes us more competitive, and it certainly makes me more competitive. And you know, what do? Well, we say before pre-POG, if you like, our strategy remains exactly the same, but more and faster. So instead of saying we want to increase new markets and new media to 35 to 40, we've upped it up to 40 to 45. We've been more aggressive on the small and medium-sized acquisitions. We're more aggressive. We're looking at any client conflict issues that come out of it. You know, and the press have not been sort of shy to come forward and suggest what the problems might be. And we'll see. I mean, we've picked up already in the first 4 or 5 weeks significant issues. It's very interesting because there was the lawyer, the Omnicom lawyer, not internal, external, Latham and Watkins, I think the name of the firm is, probably for the promotion, the self-promotion of the law firm, appeared in an interview with Bloomberg Law and was asked what is the reason for the deal. And he said, well, it's good for retirement benefits for executives. It's good for incentive purposes for executives. And it's good because Holland or Amsterdam, which is where the company will be either headquartered or registered, is the Delaware of Western Europe. That was it. There's nothing about client benefit in that.
At the time when Sir Martin made these comments, he was a lone voice stating that the deal looked iffy. Let's take a quick break here on the show. When we return, Sir Martin joins us from Beijing with his reactions to the POG collapse. Welcome back. Today, Sir Martin Sorrell joins me from Beijing, where he was attending the IAA World Congress. Sir Martin, thanks for joining us. To begin with, what are your reactions to the failure of the Publicis-Omnicom merger?
Yes, you always pick good times. Well, I guess we weren't. I guess we weren't surprised, Anand. I think we had said for many weeks that this so-called merger of equals was doomed to failure. I think we were a bit surprised by how speedily it unravelled and how speedily the obituary was announced. But having said that, I think it was predictable. I think after you and I have talked as long ago as July the 8th last year or 7th last year, I said to you that strategically it was a volte-face for both companies, that structurally it was clunky, that it was going to have regulatory issues, which it certainly has had here in China, and that it would cause problems with clients and with people. And on the client side, I think it started to escalate. I mean, virtually every day that came by, and every day we looked at TV or the press or digital journals, there was another client either up for review or moving. I mean, E-Trade announced in Europe the move from Publicis to WPP of its media business yesterday or the day before yesterday, and that was in a long trail. Pepsi in India, in China, Marks and Spencers and Compare the Market in the UK, Vodafone globally, Miller Lite. I mean, these were all examples of account moves literally in the last 3 or 4 weeks, and the momentum seemed to be building. And then finally, on the people front, I think, as you and I have discussed before, for every one person that we lost to either Publicis or Omnicom, we gained 4, and I think there was a bit of momentum building there as well. So net, it was going that way. But if one was trying to sum it up, I think the original decision was an emotional one. I think both John and Maurice wanted to use it as an opportunity to knock WPP off its perch. It didn't have much of a strategic rationale or indeed a client rationale. And if it did, they were very slow to articulate it. And I think that told. And what's interesting, it's taken 10 months for it to fall on its face, but the market moves in strange ways. And the market really did knock this on the head, I think, in the end. But there's a great phrase in England, eyes bigger than tummy, and I think this applies this time round.
Right. So how do you think they would pick up the pieces now, individually? What's the next step for both companies, Publicis and Omnicom?
Well, it's an interesting question, Anand, because if you went back, and you can archive, their calls for Q1 are archived, so you go back and listen. And what was interesting about those calls is that both companies were trying to say, we're just as good separate as we are together. So, which begged the question about, if you're just as good separately, why do you bother to get together? And I think they were preparing you and I and others for the fact they were going to split asunder. And in fact, talking to an Omnicom executive here in Beijing this morning, he said to me that really the signals, the smoke signals started to develop around December. And I heard one Omnicom executive make the joke that John Wren would never visit Paris again unless it was for Maurice Levy's leaving do. So I guess at the end of the day, the social issues, as the investment bankers call it, really prevailed.
Okay, moving on to, well, not a merger, but the Twitter IPO. I mean, the Twitter price taking a beating, and then we have the Alibaba listing. Can you share your thoughts on what happens with these two?
Well, I don't know is the answer, but Twitter, was priced well in the IPO, did well after the IPO. It's very much, I think it was sort of ARPU, it was the revenue per customer or time spent per customer that troubled people on Twitter. But, these things are roller coasters. I mean, they're very high valuations. And I don't think it's a surprise that there are both ups and downs. Google, I think, remains the strongest. Facebook is making ground. I think they're becoming much more effective and almost Google-like in some of the things that they're doing. And that's not surprising given the fact that Sorrell and others do come from Google, but they're becoming, I think, much more professional, much more effective with clients and indeed with agencies. On Alibaba, we've always been a bull on Alibaba. We saw Jack Ma in Guangzhou, 18 months ago, and we met with his new CEO for Alibaba. We talked through his plans, not just for social and sustainability initiatives, but also for the financial transactions platform and logistics platform. Tremendously impressive. We've been pushing Alibaba. We've been trying to get people in the West to understand it. Now we don't need to do that anymore. I remember about a year or so ago, we said that the valuation would be anywhere between 150 and 200 billion, and it looks like it's going to be somewhere between that. My view on Alibaba is it will have strength following the IPO, but it's a heady valuation too. But it's a fabulous business. It's got tremendous penetration and scale here in China. It has multinational ambitions. And Jack Ma, just like Sergey and Larry, is a disintermediator. So watch out, anybody who has a legacy business, including ourselves.
Right, from digital brands to brick and mortar brands. I understand you will be coming to India for Brand Z. Can you tell us why it is so important that you have to come to India for an event like this?
Well, Brand Z, as we call it, you've got the Americanization, Anand. This is extremely disappointing. But anyway, Brand Z or Brand Z is a brand valuation tool that we've been using for many years. Millward Brown developed it. We have another one, Brand Asset Valuator, done by Young and Rubicon. We have two in WPP. And Brand Z or Brand Z we developed with the Financial Times a global valuation table ranking, which has been going for about 5 or 6 years. And about 2 or 3 years ago, we decided to do it for China and Latin America. Today in New York, we're doing the top 100 Chinese brands. We did this in China a few weeks ago. We've done it for 2 or 3 years. We've done it in Latin America, top 50 brands. And we're going to do the same in India too. So we'll be trying to value India's most valuable brands. And we think this indicates the changes, some of the changes we see taking place in the world, the shift in the balance of power from the west to the east, to the south and the southeast. And some of the great brands, we mentioned Alibaba in the context of China, but there are tremendous brands, as you well know, in India, whether it's Reliance or Mahindra or Godrej or Airtel or whatever. These are brands that have become very successful in an Indian context, in a regional context, and increasing on a global context. So Brand Z or Brand Z just emphasizes the growing role of Indian brands globally.
And why is it important that you put this in your calendar?
Well, India is important to us, as you well know, Anand. I wouldn't be doing your show on a regular basis unless it was important. So it's just another demonstration of how much we value. I'm here in Beijing, and I'd like to be in New Delhi and Mumbai as well.
Right, Sir Martin, thank you so much for joining us.
Thanks, Anand.
That's all the time we have on the show today. Next month, Sir Martin will join us from the Cannes Lions Festival. Thank you for watching.